end of financial year 2023 Director's Cut. Let's do our best. Before we get going, I believe you got a special offer that I'm not aware of.
Help us meet our aim of helping as many people as we can. We're going to ask for your help. So we're supposed to close out 2023 for the first 23 of our existing clients that would like to introduce a family member, a friend, a work colleague to us. You can do that by clicking on the link below. We will give away 3 opportunities to win your mortgage repayments paid for in July if you introduce family member, friend or work colleague to our business.
Some people have got some big loans.
So yeah, we want to thank them, mate. I'm in a generous mood.
You are in a generous mood.
Talk through rates, this is what they want to hear. What's going on with interest rates at the moment?
Interest rates. So, everyone's focused on the RBA, understandably, because they've been relatively busy over the last 12 months. But what I would sit there and say is we think that rates will probably continue to increase. Yep. There's the chance that they will, maybe another 0.5%. That's what I'm telling people to budget on. But don't be surprised if those interest rate increases come from the banks and the RBA. They've done it before, right? And so the banks might do a bit of the RBA's job for them. We're starting to see interest rates increase for new lending across the board. So why are banks doing that? They're ultimately doing that because they have been writing loans that aren't overly profitable to them for the past 12 or 18 months to try and win business. They're stopping doing that. And they also don't want to go and price existing loans for existing mortgage holders. They don't want to go and put their interest rates up outside of RBA increases. Ain't going to go down too well with the public when we're dealing with a whole range of other cost of living pressures.
Also, banks have been huge on incentives to win new customers over the last couple of years now. What's going on with them?
Yeah, not as much lending done, so they're throwing cashback offers out there and discounted interest rates to win people through the door, knowing that if they come through the door, then more often than not, they hang around for a while. Cashbacks, if they're not totally gone out of the market now, are pretty much gone, or they will be gone by the end of this financial year. And you're also seeing the discounts for new lending basically being pulled back significantly. So they're the 2 big things that we're seeing at the moment, and I predict that's going to be the case for 2024.
The other major topic conversation at the moment in the media is the fixed rate cliff. And a lot of people talk about it, but they don't know what it means. So typically what that means in terms of repayments is if you were fortunate enough to fix your rate in the low 2s over the last 18 months to 2 years, you'll be reverting over to a standard variable rate in the next 6 to 12 months. What does that mean? On an average loan size, that's going to mean increased mortgage repayments of about $1,200, and that's pretty significant if you're not planning for it.
That's on when you say
on a $500,000 loan.
Average sort of mortgage size.
$500,000 loan, $1,200 increase in repayment, which is pretty significant.
And realistically, that's probably below average at the moment in terms of 500 grand. So they're big increases.
A relationship management team have been proactively calling our existing clients and getting on the front foot with those to enable our clients to be planned and prepared. We're lucky enough that about 50% of our clients are at least 12 months in advance in their mortgage, which gives them some scope and some cash flow release should they need some support to make those increased repayments.
So when you say they're in advance, they are not only in advance, but they have access to those funds. So they're sitting on cash buffers, which is making them
either in redraw or offset. Another 25% are about 6 months in advance. So, and we're calling these clients in advance before their fixed rate expires to ensure that they're planning. They understand what the repayment is going to be, so they can either start making that repayment or they can make adjustments in their financial position to ensure they can absorb that. So given that's what is happening with interest rates and what the banks are doing in response to that, what should our clients do?
Okay, so if you're on a variable rate at the moment, give us a call. And talk to us and go through what the repayments could quite possibly get to. If those repayments are above where you feel comfortable, we'll check in and see if you've got a big enough cash buffer. And if not, we'll give some consideration to restructuring your loan or potentially even looking at fixing the interest rate. Fixed 2 and 3 year rates actually sit below the variable rates at the moment. So if you need certainty and you need the repayment a little bit lower, it's a genuine option. For people looking to get into the market and buy again budget on interest rates being 0.5% above where they are. All the market's reporting that vendors are meeting buyers and they're negotiating and prepared to negotiate. So if the numbers stack up, right, if you can make some money out of it, now's as good a time as any to be acting.
Mate, you were lucky enough to sit in a round table last week, and we talked about the fixed rate cliff, but there was a talk around fixed rates in general and how they're going to impact the investment market.
It's interesting actually. So fixed rates, so if we talk about the property market, the fixed rate cliff came up and it was a discussion around what sort of impact that has been having and will continue to have as more people come off their fixed rates, or the peaks basically between now and basically Christmas time. And the thought process was that, yes, okay, the fixed rate cliff is something to think about, but it's not going to have a significant impact on the property market. The thing that's going to have a bigger impact on the property market moving forward is going to be our unemployment rate. So, interest rates, increased cost of lending can make people make the decision to put their property on the market because it's unaffordable. But if you're still employed, most people, and if you've got a cash buffer like we were talking about before, most people have been able to maintain and manage their loan repayments. But if you don't have a job, different ball game.
Yep.
So the unemployment rate is going to be the primary factor that if we start to see or continue to see a reduction in the property market, that's going to be the driver more so than any interest rate increases from where we are right now. And over the last 9 months, we've seen they talked about a peak to trough reduction of about 10%. Now, that's happened in 9 months, short, sharp, right? The previous reduction that we had in 2017, same reduction, around about 10%, but took 3 years.
Right.
Okay, so they just talked about the difference between these two reductions. The recovery is happening primarily in the higher end of the market. Houses that are $1.2 million and above. Not too hard to understand why. The people that are buying those properties are either in solid employment or have more cash, possibly not borrowing as much, right? So that's starting to lead the recovery. The lower end of the market, 650 and below, that's still struggling with some price declines, and the expectation is it's going to take that longer to sort of come out of the trough that it's in at the moment.
So given there's a bit of uncertainty in a two-tiered property market, there's opportunities. People are still looking to buy. What do they need to do?
Yeah, there's huge opportunities. We're seeing buyers advocates tell us, we're seeing real estate agents tell us, as I mentioned before, vendors are prepared to meet buyers in the market. So from a buyer's perspective, know your numbers, back to front. Understand what you feel comfortable being able to contribute towards the mortgage based upon a shortfall from the rent that you might glean if it's an investment property. If it's you're looking to upgrade your home, then the reality is you're buying and selling into the same market. So if you're buying for more, again, you just need to feel comfortable you can take on the additional debt at a slightly higher interest rate.
Wonderful. And as we close out 2023, we're really, really fortunate and proud of the fact that the business won a pretty significant industry award at the Better Business Awards last month. We won the Best Community Engagement Program, which is effectively recognising our staff for the volunteering they do in the community. There's a lot of people really struggling at the moment, and the fact that our staff value giving back to the community as much as we do is really rewarding to be recognised by the industry and our peers. So really, really proud of the fact that we won that award.
FY 2024, let's make it a positive one. Thanks for listening.
See ya.